Good afternoon. I'm Donald McLee. I'm a shipping research analyst at Berenberg Capital Markets. Be hosting the container ship panel today, where we have Tassos Aslidis, CFO of Euroseas and Eurodry. We have Howard Finkel with Danaus Corporation. We have George Youroukos, Executive Chairman of Global Ship Lease, and Deambrosio, Managing Partner of Seamax Capital Management. So just to get started, the container ship sector has undergone several changes over the past couple of years, along with some recent changes in the past couple of quarters. So I'd like to get kind of a broad idea of where do you think the current state of the container ship sector is? Yeah, let's start with you.
Thanks, Donald. Thanks, Capital Link, for inviting us for one more time, and thanks everybody for attending. Container ship sector, for us who are active in the feeder sector, the smaller containers, is in an interesting point in its cycle. The thing that I would like to highlight first is that is the order book, which is at around 13%, give or take. It's the lowest, one of the lowest levels of the last 20 years, which is quite encouraging if one thinks that even a few years back, the order book was in the order of 30, even 60% at some point during the last decade. So that, I believe, sets the foundation for a potential recovery if several other aspects of the market align.
Okay.
Let me stop here and let my panelists refer to the other sector aspect of shipping.
Okay, Howard Finkel with COSCO. A lot of changes going on in the industry. We're now, with the purchase of OOCL, and then a few years ago we merged with China Shipping. We're now the third largest container carrier in the world. Basically, alliances have become very stronger. A year and a half ago, most of the alliances shifted. We're in a new alliance. Practically every carrier is in a new alliance right now. A lot of people, there's a lot of noise in Europe, a little bit anti-alliance. I don't think this is going to hold water. I think carriers today, with a very competitive environment, even though there are fewer carriers, it's still a brutally competitive market out there. I think you really need an alliance, a strong alliance, to keep your operating costs down. Bigger vessels, you know, there's some criticism in the market. The vessels are too big. Truthfully, the largest vessels really haven't hit the United States yet. Very few ports in the United States can really handle efficiently those huge vessels, over 20,000 TEUs. But we've seen it's been a very, very strong import market for us because of a lot of shippers are trying to beat the tariffs. The export market is a little more challenging today because of some of the tariff issues with exports, but fairly strong market overall.
All right. And George?
Yeah. Thank you, guys. We on Global Ship Lease, we are focused on mainly bigger ships, post-Panamaxes, and we have some feeders as well, which are cargo and trade specific. We are embarking in an effort to educate investors on what we feel is the most important part in containers. I'm sure investors hear a lot about this story, the other story, the third story, lots of stories. I think we want to give the investors the reality story, which is the slot cost story. That's what it matters to liner companies. Howard just said that now, big ships. And we want to educate investors in containers to explain to them what liner companies are looking for, which is the lowest possible slot cost. And in this respect, that's what we're doing. We feel that as a company, we're placed exactly where we should be. Our ships are the cascaders of the smaller sectors. Our ships are the ships that provide the lowest slot cost out there, and we feel comfortable. We're moving ahead by locking in shareholder value by extending our fleet. We feel the market is very good right now. We're very positive on the future of the container market.
Same question, Cal?
We're at Seamax, similar to where George is. Our focus has always been in the post-Panamax segment. We have vessels between 8,000 and 9,000 TEU, which is basically as big as you can get without getting into new buildings, which we've stayed away from. Our view is that liner companies will always try to put the biggest ship in each trade lane that they can to lower slot cost, and it's paid out pretty well for ourselves. It's been a choppy market for the last couple of years. We're working with overcapacity, but that with a low order book and utilization rates going up, we've seen a very positive start to the year. 2019, we've seen charter rates for these larger ships getting into the mid-20s, and that should fall down to the smaller sizes as well. The whole situation with the fuel change, slow steaming potential for next year, vessels getting taken out of service for scrubber fittings should also help the supply side. So assuming demand stays more or less where it is, and people don't get overly excited with new building orders, we should be in pretty good shape for the next few years.
Got it. So it sounds like intermediate term fundamentals are pretty positive, but I think one of the kind of sentiment headwinds that have been overlying the market recently is the U.S.-China trade tariff situation. So it'd be great, Howard, maybe to hear the perspective of the liner companies on how that's been impacting trade.
Yeah, I don't really want to talk too much about that. It's a political issue. I could just say that we haven't seen a huge effect on trade. As I mentioned before, some of the imports that may be affected, the tariffs are not in effect yet. So we've had really overbooking for the last 6 months, people trying to get in under the tariffs. There is some effect on the export. That's been hit a little bit on the agricultural products. But still, that's probably in the 80% where the imports are basically in the high 90s to full. As far as where it's going to go, as I said, I'm not a politician. I don't have a crystal ball. But just sensibly speaking, I think if you look at the consumer, there's probably going to be, there is going to be an election in a year, a major election. If consumers get hit in the pocket, they're going to go for the party that they think that's going to protect them, so their $300 TV doesn't cost $1,000 next year. So we're hoping cooler heads will prevail.
Thanks. And then Tassos, maybe to hear your thoughts with operating in the feeder space.
I agree with the general framework that Howard mentioned. On the feeder space, the feeders primarily work with the regional trades and short sea routes. So to some extent, they are less dependent on the US-China trade situation. Obviously, especially if it affects trade towards China, then there might be some further effect there. But I feel that we are less affected on the feeder sector from the general trade situation between US and China.
Okay, and then just shooting a question to George on IMO 2020. In all the other shipping sectors, there's been kind of a pretty binary decision of if we're going to opt for scrubbers or not. How do you view that shaking out in the container ship sector? What do you think the impact is, and then how have kind of counterparties been managing that risk?
Yeah,
that's good.
Okay. First, if I may, I'd like to give a different view on the trade war, if I may.
Sure.
Yeah. I think trade war, as it might seem strange to most of the people here, was the best thing that has happened to containers in the last few years. Our industry is cyclical, not because we have a cyclical demand. Every year demand is bigger than last year. Sometimes by a bigger number growing, sometimes by a smaller number growing, but it's always growing. So the reason we have a cyclical market is because of the supply. And trade war has put the supply in check. It has scared the shit out of people, and there was no ordering. And that's the best thing that could have happened to us. Right now, the order book going forward is the lowest we ever had. And honestly, I'm not worried about trade wars. I cannot imagine that, goods are going to be produced in the United States instead of the Far East. They're not going to be produced in China. They're going to be produced in Vietnam or somewhere else. So that's my view on trade wars. Now, going to 2020, I believe that container ships having usually, on an average, 5 times the engine, a container ship has 5 times the engine of a bulker or a tanker of similar deadweight. They consume a lot more fuel than any other kind of ship. So fuel economy, it's of paramount importance in container versus other types of ships, for one reason that I mentioned, and another reason is that they are more at sea. Container ships have more seagoing days than any other type of ship. They sail more. Therefore, we expect, and we already see this happening, that the container fleet is going to slow down, maybe 1, maybe 2 knots. All services are going to slow down. That is going to offer liner companies less cost, and at the same time absorb the unnecessary capacity that exists in some sectors, such as the big ships. So it's a double whammy. So I'm a strong believer that 2020 is going to reduce the fleet net of new buildings minus slow steaming. Every 1 knot is reducing about 5% the fleet size. So a couple of knots is what we see happening in most trades. Slow down. So that can create an undersupplied market going forward. And from what we see, a lot of liner companies are getting themselves prepared for that. Scrubbers is not an issue for containers. It's not like it's not something that is a speculative approach that is in tankers or bulkers. In our industry, we only install scrubbers on the back of charters. So, if the liner company wants a scrubber, we install it, and we get a longer charter, and we amortize it.
Okay. Question, sorry.
Yeah, I'd like to just make, for a liner company, I really think this is going to be the most important issue in determining whether liner companies are going to be profitable or not in 2020. Just starting the contract season right now, I definitely think you will see some increases. Of course, not exactly what we want, but we're seeing the numbers go in at least a positive direction. However, in the past, we've had a bunker formula that was fairly transparent to the shippers, accepted in the market, and we did it through something called the TSA, which was the Trans-Pacific Stabilization Agreement. This we actually did away with. It was, as most of you probably know, in the United States we have antitrust immunity. So the carriers are able to get together, discuss things like rates and surcharges under very, very limited conditions. However, we kind of disbanded the TSA last year, and now everybody has their own IMO formula for this new bunker. And I'm hoping this doesn't turn into a commercial issue, because there's not one forum right now. And truthfully, shippers will do anything to kind of play carriers off each other. I'm talking to a couple of the major companies that track bunker. One of them, Platts in England. I had a meeting with them 2 weeks ago. I'm trying to get them actually to talk to the Federal Maritime Commission and get a forum together so the trade actually has one bunker that they accept, because a lot of the carriers in 2019 that didn't do as well, they had those outcomes because they weren't collecting the proper bunker. So hopefully when we have to buy, we're not going to use scrubbers on any major factor. That it's going to be small. We're going to purchase the low sulfur fuel, and we have to get a bunker formula that works.
Interesting. Question for Cal. Echoing some of Howard's earlier comments around alliances and a more consolidated counterparty base, also coupled with kind of declining operating margins last year, how do you think about managing your counterparty risk?
Well, I think from a ship owner's perspective, consolidation on the liner side is not the greatest thing. I mean, you have less clients to talk to, but there's a couple of things that are offsetting that. Now, there's smaller players that are stepping up. So we see liner companies that in the old days were operating with vessels in the feeder sizes or Panamaxes that are now stepping up and doing larger sizes. So other people are stepping up. We're worried about next year. I totally agree with everybody's statements here that overall the IMO 2020 and the fuel change will be overall positive for ship owners because they'll absorb demand. The part that we're got to watch closely next year is the counterparty risk from a ship owner's perspective, because are the liner companies going to be able to effectively transfer that fuel cost increase to their customers? The industry has not always been the best at doing that, and so it's going to be a wait-and-see attitude from that perspective. But ourselves, we're getting ready for the transfer. Most of our ships we're putting into charters that are going to take us into next year, so we don't have to deal with a switchover, let's say, in December or January. And but we think it's, as I mentioned earlier, the outlook is quite positive right now.
Okay. Switching gears a bit, in terms of opportunities, where do you think the most interesting growth opportunities are over the next 12 to 24 months? We can start with you, Charles.
We can look at the order book and what types of ship people are ordering to get a sense of where the industry is going. If you look at the order book, you see a bipolar picture. You will see people ordering feeders. There's 13% order book for the feeders, and large container ships. The very large one, they have an order book of 50+%, and everything above 12,000 TEU is being ordered. So I think these are the two areas that would attract the most demand in the market. That's why I guess people are ordering it, and this is what the liners and the needs of the trade require. Either very large ships that reduce the slot cost, or smaller ones like the ones that we operate, that take and distribute the containers on a local basis. So I think if you are a big company and with bigger capital that you can deploy, you can naturally look at the bigger vessels, the really big ones, not the middle range. But or if you are a smaller player like us, really the feeders is where you want to be, and which are somewhat protected also from the cascading that was mentioned earlier.
Just following Kyle, maybe you have a response to Tesla's commentary, just because you guys are kind of focused in the post-Panamax segment?
Yeah, I think that, I would stay away from new buildings as long as possible, because the reality is that we've had too many ships for too long. I think the opportunities right now lie in the second-hand tonnage. Charter rates are significantly been increasing over the last, let's say, 6 to 8 months, while asset values remain flat. So right now, you could buy second-hand tonnage at relatively depressed market values and get a pretty good charter rate for the next 12 to 18 months. So I would focus more on that for the time being. I think, stepping back a little bit on the China war with the U.S. situation, we're more concerned about Europe than really the U.S. for the time being. I see Europe pretty depressed. Youroukos and ourselves are going to be faced with those ships, the larger ships being cascaded into the more traditional mid-size 8,000, 9,000 TEU ships that are doing the Trans-Pacific. But overall, again, I think I would focus on second-hand tonnage for the time being.
If I can correct, I didn't mean to order new buildings necessarily. Simply looking at the order book, you get a sense of where the industry is going, and you can buy very well second-hand ships of those sizes.
Just highlighting your comment on where asset values are currently. So it makes sense on the second-hand basis, but do you think there's the potential for consolidation on the owner-operator side? Maybe starting with George, you guys kind of done the most recent transaction.
Yeah, I think it makes sense. It does make sense a lot for consolidation, but consolidation has to have a reason for both parties. I mean, for us, it would make sense because we would grow the company by doing a NAV to NAV ships for shares transaction, and for somebody who would want to merge with us, come and join us, it would make sense because it would give to that party liquidity and access possibly to things that they don't have access. Being a public company versus a private company, the moment you're public, you get access to more finance, other types of finance, and so on and so forth. We all know that the capital markets right now, they're not open as we would all want to be, but capital markets open and close very quickly. So, if the market is there, I think capital markets will view the opportunity and grab it. Okay.
Maybe then going back to Cal, George touched on kind of the dynamic between public and publicly traded companies and private companies. Do you think there's any maybe pros to potentially still being private in this current capital markets environment?
Well, I'd rather be private right now in many ways, but I think that being public adds several $1 million of cost to any operation. That's the only certain thing that it's doing right now. The benefits right now, as I think that we've heard from prior talks, has been quite difficult at capital markets. We're still we run our business very conservatively. Our debt ratio is less than 50%. So we have a lot of operating flexibility, and we don't really need to access the capital markets or the private markets. So I think at some point we'll be looking for liquidity, and the capital markets do offer that exit. And with public shares, that gives you obviously the ability to acquire assets as well and grow the fleet if the public markets are available. But there probably needs to be some level of critical size. There's a lot of small publicly traded companies that may be stuck now, and they may be stuck in the future as well. So that's something else to consider. If you're going to be out there public, you got to take advantage of that market and not do it as some other reason.
Sure. Maybe a general question for the panel. So it sounds like you mentioned scale is a pretty important factor. What are some of the other things, assuming a more attractive supply-demand fundamental backdrop going forward, where you think that'll get investors attracted to the sector? Do you think a more accurate or a better use of capital right now is buybacks, or are you considering dividends a better way to return shareholder capital? Just what are your thoughts there in terms of attracting people to the capital markets?
I'm not sure the industry is at the point of returning shareholder capital. I mean, we have a decade that was pretty challenging for the most part of it. I think really there are opportunities to invest in assets, to possibly buy back stock, depending on the company size and the liquidity available. But I think but the most important way, the most effective way to attract investor interest is if the market improves and allows the payment of dividends. I think that would restore more normality to some extent in the sector overall, and that would create investor interest again.
Yeah, I think also you have to look at individual companies as far as innovation. You know, it's a fairly old industry, not known for its innovation, but there's certain things like my company. Years ago, everybody was talking about we need a faster route into the U.S. Midwest, and there was a port up in Canada called Prince Rupert. Wasn't a container port. We went there, and it's become a huge success. It's the fastest gateway into the American Midwest, fastest gateway from China to the North American continent. We just recently put a direct port call into Tampa, Florida. That we see is going to be a very positive move. The Gulf, we've expanded. We have 2 services into Houston. You really have to look at the companies and what they're doing to serve the trade. At one point, you know, Long Beach, LA is still the largest port in the U.S., but there's congestion there. So people are building distribution centers all over the United States, and the carriers are going to do well, are the ones who can get the cargo into those distribution centers the quickest.
Okay. And anything for you, George?
Well, I think that a successful public company, first of all, has to be public. So it has to have as much possible float, public float, and liquidity. So my wish list would be to grow our, you know, for our company to grow our public float and allow investors to come and go into the company as they please. Obviously, I will agree very much with Tassos. Dividend is important for shareholders, but also stock appreciation. That's what I think it's really what matters.
Another broad question, just what do you guys think about the potential for technology to impact the container shipping sector specifically? There's a lot of room for the potential digitization of shipping records. There's obviously blockchain was a big thing maybe a year and a half ago. There's also the potential for 3D printing on container ships and things like that. So just interesting to hear your thoughts on maybe the viability of some of those longer term trends becoming reality.
You are the best.
Yeah.
Technology, there's a lot of technological advances. I could say truthfully, COSCO, even though we've grown now to the third largest carrier, in the past I wouldn't say we were the leaders in technology. However, we purchased OCL, who is actually very, very advanced in technology. Their computer system, second to none. A lot of the other carriers actually purchased their system. So we went from 75 to 100% as far as that's concerned. As far as in-house systems, there's things going on right now as far as online booking, New York Shipping Exchange, blocking out pieces of business. That's starting to make some headway with some shippers. There's a huge problem that carriers have with exports, with fall down, and carriers actually never charge for this. So sometimes you'll book the vessel at 100% and it sails at 90% because of fall down. And now there's certain areas like in the Gulf now, they're talking about an explosion of synthetic resin. And these people want guarantees, so something like the New York Shipping Exchange, where you can actually block out cargo, but you have to pay for it up front. And if you don't actually use it, there is a penalty. So these things are on the horizon, and hopefully the industry will catch up with some technological advances.
But more generally speaking, if I can add a word, is if you look at the container shipping industry, is the one sector of the shipping industry that carries very different items, commodities, inside the boxes. So the information flow compared to dry bulk or to LNG or to tankers is immense. So if a sector is to benefit from technology applications, from blockchain to all other financial technology innovations, is container shipping in terms of tracking the content of the containers, not to exclude security reasons for that, to facilitating customs processing and all kinds of things that follow the cargo. Container ship is the area where the most of these innovations will provide.
Do you think there's a specific catalyst that has to take place before that actually begins to gain more traction? Because the technology has been available for a while, but I guess given how diverse and broad the sector is, it's difficult to get consensus.
It's difficult to get consensus, but starting from the security field, the pressing needs of the security of our ports, I think sooner or later, and I believe sooner, will dictate implementation of this new technology into container shipping. I think this is, if you look at the United States, one area that we are vulnerable is primarily what comes in our ports. Nobody knows exactly what is or could be in a container ship. So there, I think that would create the catalyst, as you say, for the implementation of technology. And if it starts there, I think it will easily flow in all other aspects of the business.
Okay. We have about 4 minutes left, so I just wanted to open the floor to you guys and maybe tell investors why they should be looking at container shipping and specifically your company.
Again, I start. Okay. Euroseas is the only publicly listed company solely dedicated on feeder container ships. So we believe we provide an option to investors to play that sector, which, as I explained earlier, is the one that is one of the sectors that the industry has selected. The feeders are getting most of the attention alongside the bigger ships. And I think that, and Euroseas provides a viable alternative there. We are a company that has been public for almost 15 years. We have a very transparent operation and proven management. So we believe we can take advantage of the opportunities ahead of us in investing in the right units and provide good returns for people who trust with their money.
Howard?
Okay. As mentioned, COSCO is now the third largest container carrier in the world. We're the largest actual shipping company. When I started with the company, I'm going on my 25th year now. It was a much different situation out there. We were basically following some of the other carriers into the Trans-Pacific. Now we're actually probably the leader in the Trans-Pacific. Even though China has been hit As far as the volume coming out, it's still the manufacturing capital of the world. So we are basically set for probably the best service to and from China to the world. We're looking at innovations. As I mentioned, Prince Rupert, we opened that up. Most of the major carriers are now following us in there. We opened up Boston. We opened up the Gulf. So we're actually, we just don't go to ports and ask the shippers to follow us. We go where the shippers need us to go. And sometimes it's unproven areas, but from the history, it's proven that we've made the right decisions along with our shippers.
George?
Yeah, okay. Well, our company, GSL, I would say, is a new company. It was a transformative transaction in November, which completely changed the company. The NAV went from 100 million to 500 million. And our stock is very undervalued as we speak. There is a series of events that have happened. Unfortunately, we don't have an analyst coverage, so the industry does not really know or doesn't have the time, haven't spent the time to know the value that is in our company hidden. And we're very comfortable that sooner or later the industry will know about it and the stock price is going to really boom. So I would say that we're more than happy to take meetings with people and explain why they should invest in our company. We do have the type of ships that provide the lowest slot cost, which is the most important figure for liner companies. So we believe that we're well placed, and we are, as we speak, capturing the upside potential of the container market that is happening. So that's, I think, summarizes. But may I say something about liner companies? I think that my personal view is that liner companies are going to be very profitable next year, all of them, simply because the surcharge is going to be there. There's no way. It's a matter of survival. They're all going to put the surcharge. Whether they do it collectively, independently, it's a matter of survival. So they're all going to put the surcharge of the fuel. I have not a single doubt in my mind about it. And also, the goods that containers carry are so expensive, and any surcharge has a minimal impact into the product value. Now, once they put this surcharge, all of the liner companies have installed a number of scrubbers in their ships. And I believe that all the benefit from the scrubbers is going to end up into their balance sheet as profit. So my view is that stock prices of liner companies next year are going to be good, and hold me to that and see. Thank you.
Okay, and Cal?
Well, the only thing I would ask is that people don't invest in new buildings again. That's we're going to have a couple of years of good fleet utilization, and I think most secondhand tonnage is very attractively priced right now. Most public shares are very attractively priced right now, so there should be plenty of ways to make money and staying away from the new building market.
Okay, I'll stop there, see if there's any questions. Otherwise, we can head to lunch. All right.